Deductible is your first share. It is the amount you pay before insurance contributes to a covered claim. In practice, a car repair claim of $3,000 with a $500 deductible leaves $2,500 for the insurer. Deductible controls claim sharing. Focus on the practical signs. Compare the lower premium with the cash needed after a loss. It discourages tiny claims, makes the topic concrete. Small losses stay with the customer so the system is not overwhelmed. Common case. A scratched bumper below deductible may not be worth claiming. Deductibles filter minor losses. The impact is concrete because a low premium can become stressful if the deductible is too high to pay during an emergency. Higher deductible lowers premium explains the first problem. Accepting more first-dollar risk usually reduces monthly or annual cost. In practice, a homeowner raises deductible to save on premium. Savings must match your emergency fund. A claim is easier when the required documents are clear before the loss. The first clue to isolate is low deductible buys convenience. Paying more premium can reduce shock during a claim. In practice, a family with little savings may prefer lower out-of-pocket risk. Check the facts on the ground. Check whether the deductible savings are worth the emergency bill. Deductible choice against savings and claim likelihood rather than vague advice. Deductibles vary by coverage. One policy may have different deductibles for collision, theft, wind, or health services. Picture. A storm deductible may be higher than a regular home claim. Use the real-world clues. Ask if the premium discount just shifts the cost to claim day. In a normal case, compare monthly savings with the money required during a claim. The main lever is percentage deductibles surprise people. Some catastrophe deductibles are a percent of insured value. 2% on a 4,000 home is $8,000. Percentages can be much larger than expected. Check the visible signals. Make sure the cheaper plan does not create a cash shortage later. Medical plans may combine deductibles, copays, coinsurance, and out-of-pocket maximums connects the private choice to the visible outcome. Think of a doctor visit can be treated differently from surgery. The mechanism shows up when a doctor visit can be treated differently from surgery. It shows why deductibles are the part of a covered loss the customer pays before insurance responds. Not every service applies. Some preventive care or network services may bypass deductibles. Seen when a checkup may be covered before the deductible is met. Plan design changes behavior. Early clarity can prevent a rushed or emotional decision. Deductible is not a fee to insurer. It is the unpaid part of the covered loss. Understand who receives payment. Look for specific signals. Check whether the deductible savings are worth the emergency bill. When it matters most, ask if the premium discount just shifts the cost to claim day. Claim decisions still depend on coverage. Paying a deductible does not make excluded damage covered. Version. Gradual water damage can be denied even if you are willing to pay the deductible. Use concrete checks. Compare monthly savings with the money required during a claim. In practice, make sure the cheaper plan does not create a cash shortage later. Multiple claims mean multiple deductibles. Each separate event can trigger a new deductible. Case. 2 storms in 1 year may cost 2 deductibles. Frequency affects out-of-pocket cost. Deductible choice is risk budgeting. Choose an amount you can actually pay after a bad day. Think of a high deductible saves money until a claim arrives. The simplest check is deductible choice against savings and claim likelihood, because it replaces guessing with something observable. A deductible is the part of the loss the customer agrees to absorb before insurance starts paying the covered amount. When claim threshold changes, people often adjust around it before they fully understand why they feel pressure. Businesses use deductibles strategically. Companies may self-insure small losses and insure major ones. Common case. A fleet accepts minor repair risk to reduce premiums. Risk retention can be deliberate. Check the practical signs. Compare the lower premium with the cash needed after a loss. An early response works better when it is aimed at premium trade-off rather than a vague feeling that something is wrong. Deductibles also change behavior. A person with a $500 deductible may not file a claim for a $700 loss, because the payout after the deductible may not be worth the claim history, paperwork, or possible premium impact. That is why the deductible is not just a number buried in the policy. It changes the real decision after a loss. A low premium can feel attractive until the deductible is too high to comfortably pay during an emergency. Deductible is what you pay first. Limit is the most insurer pays. Concrete case. Confusing them can lead to dangerous assumptions. Look for measurable clues. Check whether the deductible savings are worth the emergency bill. The topic becomes concrete when confusing them can lead to dangerous assumptions. It shows why deductibles are the part of a covered loss the customer pays before insurance responds. Premium savings should be weighed against possible claim payments. Notice this. Saving $120 a year for a $2,000 higher deductible may not suit everyone. Follow the visible clues. Ask if the premium discount just shifts the cost to claim day. The example is a customer chooses a lower premium but cannot afford the deductible after a claim, and the response is deductible choice against savings and claim likelihood. A deductible should be chosen with a real claim in mind, not only with the premium quote on the screen. Customers should know deductible amounts before signing. Concrete case. Discovering the amount during a claim adds stress. Clarity belongs at purchase time. Check what is observable. Compare monthly savings with the money required during a claim. A claim is easier when the required documents are clear before the loss. The deductible makes small claims less attractive and keeps the policy focused on losses the customer does not want to carry alone. A deductible is not a hidden punishment. It is the part of the loss the customer agrees to carry before the insurer pays. Choosing the right deductible means balancing monthly affordability with emergency cash. The weak point appears when the best deductible is not the lowest or highest automatically. A policyholder with a high deductible needs cash ready before the insurer pays the rest of a covered claim. A deductible is the amount the policyholder pays first on a covered claim. Higher deductibles can reduce premiums because the customer keeps more of the smaller risk. A deductible is not a penalty. It is the share of a covered claim you agreed to carry yourself. The clearest sign is a customer chooses a lower premium but cannot afford the deductible after a claim. A deductible is the part of risk kept by the policyholder. A household choosing a deductible should imagine writing that amount today after a stressful event. The wrong deductible can make a policy look affordable until the day the customer needs to use it. Choosing a higher deductible can lower the premium, but it also means a real claim needs more cash from you first. The cheapest policy can become stressful when the deductible is too high for your emergency fund. The right amount depends on whether the lower premium is worth the cash you would need to pay immediately after a covered loss. The trade becomes real after a loss, when the household needs enough cash to pay the deductible before insurance covers the rest.